welcome to another episode of Table Talk Tuesdays with the Property Sisters. We're excited today to have a special guest with us, which is Lauren Patterson. He is a mortgage consultant with Patriot Home Loans. So Lauren, thank you for being here with us. Why don't you tell us a little bit about what you do, how long you've been in the industry, all that fun stuff.
I've been in the mortgage industry now for 27 years. I've worked as a lender, I've owned companies, I've been an FHA underwriter, so I've pretty much seen everything that goes on.
So Lauren, take us through the pre-approval process. I know for buyers that can be a really intimidating time and it really doesn't need to be, so maybe simplify it for the viewers out there.
So the pre-approval process is something that a lot of people look at and think, oh no, this is what I have to do. It really, in its most simplistic terms, comes down to what do you have, what do you make, and what do you owe, okay? And from there, then we'll look and see, we'll pull together documentation, we'll have them make a credit application, and then we'll verify that information. And usually it takes us about 24 to 48 hours to issue that initial, here's your pre-qualification / pre-approval.
So Lauren, tell us why you think people should not wait for the big recession to happen again. I know people are really hesitant in purchasing and going out. Tell us why maybe that won't happen again, or maybe it will.
So that's a great question. A lot of people wonder about they call it the big R, right? The big recession, the one that happened in 2008. If you look back at the recessions that had happened previously, so there's a total of about 5 of them that have happened in the last 50 to 60 years. Of those, there's only been 2 that property values went down. Okay, 2008 and then the one before that. The one before that, if we look at the numbers, it was actually only about 1.5% decrease in property values through that recession, because the economy can't continue to go up all the time. It actually has to correct and then normalize itself. So if we take out of the equation that one recession where values went down only about 1.5%, exclude out 2008 because that was the only recession where housing actually pulled us into the recession. Usually recessions are started by other parts of the economy and then housing follows. Okay, so that was the big one, and that was the one that everybody recognizes and realizes. But if we look back at the other 3 then out of 5, because we just took one of them out, so really 3 out of 4, home values actually increase throughout recessions.
So if we were to head into a recession again now, what would you say is the difference between what's going on now in today's economy versus what happened in 2008?
So if we look back to what happened in the 2008 recession, which everybody refers to as the Great Recession, lending guidelines and underwriting standards were extremely loose at that point. People could state their income, they could state their assets. It didn't matter where they worked or really what they were doing, and they could borrow in many cases over 100% of the value of a home, okay, on primary homes and investment properties. So it created a climate where people simply couldn't afford the real estate they were buying. If we fast forward to today with the regulations like Dodd-Frank and ability to repay, all of that's being cross-checked and verified to meet the qualified mortgage standards that are out there. So we don't have that same type of lending guideline that's out there that allows people to go and amass 10, 15, 20 different rental properties or pieces of real estate that they may or may not be able to afford.
What would you say, Lauren, are the biggest myths and misconceptions when it comes to securing a mortgage? What would you tell people out there?
So some of the biggest myths that are out there with respect to getting a loan and getting a mortgage today is that you have to have 20% down. Okay, we hear that all the time. If you listen to MSNBC, CNBC, you have to have a big down payment, and that's just not true. Okay, you can do them with minimum down payments of 3%, 3.5%, and in some cases 0% down. The other thing that we hear a lot of people saying is I've got to have perfect credit. I've got to have 700 plus. I have to have a 750 credit score. And that's just not the case either. Okay, you don't have to have perfect credit like that. Many of the programs are actually geared to work towards people that have credit scores in the 600s and in the 500s in some cases as well. So the best thing to do is consult your mortgage professional and find out truly what you can and can't do, because guidelines are changing every single day.
So Lauren, the average home is $350,000. What is the difference between last year's interest rates and this year's, and how would that affect your monthly payment?
So if we look back at a year ago, the average interest rate, if you look at all the different programs, was running about 4.5%. In today's market, again, that same average interest rate amongst all the different programs is running at about 3.5%. The difference that makes in your monthly payment on that same $350,000 house last year to now is about $225 to $250 a month in payment, okay? Now, if somebody wanted to keep the same payment that they had last year and translate that into what's their buying power, it means that now you could buy a house that's actually $35,000 more than the house that you would have bought last year, given that same payment.
The reason why I love working with you is because when it comes down to working with each one of my clients, you really go above and beyond and educate them on the process. I know that you run through different scenarios and really place in front of them what would work best in their situation, and you really customize it to each client. So I want you to touch a little bit on the process that you take with each client and what sets you apart from other lenders as well.
What sets me apart from other lenders and loan officers is I believe that mortgage financing can be used strategically, okay? There's a lot more to it than simply what do you have, what do you make, and what do you owe? And it's asking the client, what's important to you? What are your goals? What do you want to accomplish? Do you want to have it paid off sooner? Do you want to have it paid off later? Once we've done that, it's looking at all the different financing options, because as a broker, there's not just one place that I go for rates and programs. I get to shop the entire marketplace to find what works really well for you, which may be different than what works for your neighbor. With that, the next thing that we want to do is figure out what's the lowest total cost option for you, both in the short term from a monthly payment standpoint, but also what enables you and your family to generate the most net worth and wealth for your household.
Well, Lauren, thank you so much for being here, taking time out of your busy day. I know you're very busy, so thank you for being here. It's great information.
And we will put Lauren's information in the comments, and if you have any questions, reach out to us or Lauren.
Thank you for joining us. Be sure to tune in next week for another Table Talk Tuesday.